Hello and welcome to BYJU'S Exam Prep IAS. Welcome to the big news of the day. The topic for today is the sudden and big hike in repo rate that was announced by the RBI yesterday, which follows a similar decision of the US Federal Reserve to raise interest rates. These monetary policy decisions of the RBI and the US Federal Reserve have been designed to contain rising inflation levels in their respective economies. So in this short and crisp analysis, we are going to understand the monetary policy of RBI and what is repo rate and how does it help in containing inflation. We shall also discuss the impact of these rate hikes by the RBI and the US Fed, both on the Indian market and as well as on the global markets. But before we begin, let me remind you that as a part of our Target Prelims 2022 crash course, tomorrow we are going to have a special session on art and culture related places that were in news. So do make use of this free crash course, which has been designed to help you in your prelims preparation, and watch this video live tomorrow at 7:30 p.m. on our YouTube channel. Now coming back to the topic of the day, the Reserve Bank of India has hiked the repo rate sharply by 40 basis points to 4.4%, and it has also increased the CRR or the cash reserve ratio by 50 basis points to 4.5%. The Monetary Policy Committee of the RBI has taken these decisions in order to contain rising inflation levels and also to tackle the impact of geopolitical tensions on the Indian economy. Yesterday, in an unscheduled meeting, the governor of RBI, who also happens to be the chairperson of the Monetary Policy Committee, announced that the central bank is going to retain the accommodative monetary policy in order to favor growth, while taking steps to rise the repo rate and CRR in order to contain inflation, which has been reaching dangerous levels. This sudden move by the RBI happens to be the first rate hike since the last 4 years, and it will definitely have an impact on the economy as interest rates are going to go up in the banking system. See, over the last few months, inflation levels in India have reached record levels, and it has touched 7%, which is way above the maximum range of inflation, which has been fixed at 6%. As a result of the pandemic and disruption in global supply chains, accompanied with the disruption created by the Russia-Ukraine war, the global economy has been facing turbulent times. So over the last 3 to 4 years, the RBI had consistently maintained a pro-growth monetary policy, which led to the introduction of cheap money into the markets. And now, the excess liquidity in the economy has resulted in rising inflation, and containing it has become a top priority for the RBI. Hence, the RBI has decided to deploy its policy tools such as repo rate and CRR, and the rates have been hiked to 4.4 and 4.5% respectively in order to bring down the high levels of inflation. But to further understand the topic, first we need to know about the RBI's role in crafting India's monetary policy. See, the RBI or the Central Bank of India is primarily responsible for managing the country's monetary policy. This essentially means the RBI is responsible for managing the money supply or liquidity in the economy in order to strike a balance between growth and inflation. Until 2016, the RBI alone was responsible for coming out with the monetary policy. But in 2016, the RBI Act of 1934 was amended to provide for the establishment of the Monetary Policy Committee, which has been made in charge of the monetary policy of the nation. The task and mandate of the Monetary Policy Committee is to maintain price stability and ensure that there is just enough liquidity in the economy to promote growth while striking a balance with inflation. This Monetary Policy Committee is comprised of 6 members, and the chairperson of the committee happens to be the governor of RBI himself. Apart from the RBI governor, there will be 2 more members from the RBI, and 3 other members shall be nominated by the government. So this committee is accountable to the government and answerable to the government if the growth and inflation targets aren't met. When the Monetary Policy Committee was set up through this amendment, it was entrusted with the task of fixing the benchmark policy rate, which is the repo rate, and it also legally fixed an inflation target of 4%, which has to be maintained by the Monetary Policy Committee with a range of plus or minus 2%. It essentially means that the ideal inflation target for Monetary Policy Committee prescribed by the government is 4%, with a lower threshold of 2% and a higher threshold of 6%. So it is the job of the Monetary Policy Committee to keep inflation levels within this range and strive towards achieving an inflation of 4%, which is ideal for growth in the Indian economy without hurting the common man. But as we discussed, inflation levels have been touching 7% in India, which is way above the prescribed target, and hence the Monetary Policy Committee has decided to hike the interest rates immediately in order to bring down inflation. Now the obvious question is, what is repo rate and what is CRR? See, repo rate is the primary policy rate available to the RBI, which is a monetary policy tool for managing liquidity in the economy. Repo rate is the rate at which the RBI lends money to commercial banks. So obviously RBI can use this interest rate as an incentive and as well as a disincentive to regulate the borrowing by commercial banks and thereby regulate the money that is available with them for lending in the economy. So if the RBI reduces the repo rate, then it becomes an incentive for the commercial banks to borrow more from the RBI, which means the banks have more money with them and they can provide more loans to consumers and as well as to large borrowers at cheaper interest rates. On the other hand, if repo rate is increased as it has been done now, it becomes a disincentive for the commercial banks to borrow from the RBI, and as they will be left with less liquidity, they will provide fewer loans and automatically the interest rates will have to go up. So essentially repo rate is a tool for the monetary authorities to control inflation, and cash reserve ratio or CRR falls in the same bracket. CRR is a portion of commercial banks' total deposits that they need to maintain with the RBI in the form of liquid cash. This deposit that commercial banks would have placed with the RBI cannot be utilized by the banks for their borrowing activities. So essentially, if the CRR rate is increased, it means the commercial banks will have to deposit more with the RBI, and this leaves little cash behind with them and automatically reduces their lending activities. So this in turn becomes a tool to contain money supply in the markets by reducing borrowings and thus helps in controlling demand and inflation. Now to get a better understanding of this complex topic, let me use this chart and explain the complicated task of balancing growth and inflation. See, growth and inflation, that is promoting growth and containing inflation, happen to be inversely proportional to each other. So if you try to promote growth in excess, it might lead to inflationary situation. On the other hand, if you try to excessively control inflation, it might affect growth prospects and thus affects the broader economy. Now see, to promote growth in the economy, what you need is demand. And to sustain demand, there should be enough liquidity. Meaning people and companies should have enough money with them to purchase what they want, and this pushes up demand and thus introduces growth in the economy. And in order to place more money in the hands of consumers and borrowers, the cost of money has to be low, which means the borrowing rates or the interest rates has to be low. So if the RBI adopts a pro-growth policy, then it has to reduce the interest rates, meaning repo rate and CRR will be reduced so that more cash is available with the banks and they can lend out cheaper loans to the consumers and borrowers, thereby increasing money supply in the market. So borrowing becomes cheap, demand for goods and services goes up, and if done at the right level, it will promote growth. But if money supply or liquidity becomes excessive in the markets, it will boost demand to such levels that it will start pushing up inflation. So as inflation increases, it will start putting pressure on other macroeconomic factors, and the prices of essential items will go up and will hurt the common man. So then the RBI will step in to increase the interest rates so that inflation can be contained and brought down. If RBI increases its policy rates, such as repo rate, CRR, and the others, then it can increase the cost of borrowing for commercial banks, and with less money left, commercial banks will give out fewer loans at higher interest rate, and this automatically discourages borrowing by the consumers and the large borrowers. So as a result, money circulation decreases, borrowing becomes expensive, and the demand for goods and services also decrease. This will help in containing inflation, but if it is not done in the right way, it could adversely affect growth. It could even push the economy into a recession, or in a worst case scenario, it might lead to a stagflation situation where growth has stagnated with high levels of inflation along with high levels of unemployment. So, striking this fine balance between promoting growth and keeping inflation at ideal levels is a challenging task for the central bank and the monetary policy authorities of any country. In fact, in a move similar to the RBI, the US Federal Reserve has also hiked interest rates, and this happens to be the biggest increase in interest rates since 2000. This is considered as one of the most aggressive tightening of monetary policy by the US Federal Reserve in 2 decades in order to contain rising inflation. The US Fed has increased the benchmark interest rate by 0.5%, which is the biggest rise in 2 decades. And this comes as positive news for US treasuries and stock markets. Because generally interest rates are very low in developed economies such as the United States. And hence, most investors look to invest their capital in developing economies like India, where they fetch higher interest rates. But if the US Fed increases the interest rates, then automatically capital will start flowing back from developing countries towards developed economies like US. And while this is good news for US treasuries and US stock markets, it will take a massive hit on the Indian stock market. Then in the domestic economy, the impact of RBI's rate hike will be felt in the coming months, as commercial banks will be forced to transmit the monetary policy down to the level of the consumer. Now, as the cost of borrowing for commercial banks from the RBI goes up with the increase of repo rate and CRR, commercial banks will be forced to increase the borrowing rates, and this could take a hit on consumption and demand in the economy. Experts predict that this will increase EMIs on already borrowed loans, and it could further dampen key sectors like housing and automobiles, where the consumers are heavily dependent on bank loans, and the full impact of this would be felt in the coming months. But parallelly, the banks would also increase deposit rates in order to attract more money into the banking system, and this could be good for certain investors. The hike in CRR by 50 basis points is going to suck out 87,000 crore rupees from the banking system, and thus will significantly hit the lending capabilities of banks, and as a result, interest rates on loans will definitely go up, and thereby it will help in containing inflation, which has reached record levels. But however, the RBI has assured that for the time being, it is still going to adopt an accommodative monetary policy towards growth, because the Indian economy and global economy are still facing several challenges. We are still not entirely out of the pandemic, and the global supply chain disruption still remains in place, and the war in Ukraine continues to drag, and hence the RBI has assured the markets that it is going to continue with its accommodative monetary policy, and it will be ready to boost growth if required, while focusing on containing inflation in the short term. So this brings our discussion to an end, and if you found the initiative to be helpful, don't forget to like, share and subscribe. Thanks for watching.